Welcome to vTalkInsight, Allocator's Lens Daily for December 12, 2025. The Federal Reserve has just delivered another rate cut and a surprise wave of Treasury bill buying. Even as long-term yields, AI-related risks, and credit tensions keep this a very late cycle tape. Today we connect those policy moves to what they mean across equities, rates, credit, currencies, and commodities from an allocator's point of view. Equities are trading with a curious mix of optimism and fragility, as the S&P 500 index grinds to fresh highs while implied volatility slips back toward the mid-teens. Shallow pullbacks continue to be bought, helped by strong liquidity and heavy retail inflows, yet valuations and pockets of AI exuberance leave little room for disappointment. The AI theme remains central, but is getting much more two-sided. On the positive side, companies like Broadcom are beating expectations and guiding AI semiconductor revenues to roughly double year-on-year, helped by custom chip demand from major cloud providers, while leading equipment makers describe the current AI infrastructure build as fundamentally justified rather than speculative. At the same time, Oracle's earnings miss, negative free cash flow, and heavy AI capex have triggered an 11% share price drop and a sharp rise in its credit protection costs, showing investors are now penalizing aggressive spending without clear near-term returns. That split underscores a broader debate about whether AI equity valuations are already pricing in implausibly large future cash flows. Some estimates imply profit pools that exceed today's major global markets, and there's open skepticism that smaller AI firms can honor very large infrastructure commitments, with comparisons being drawn to the late 1990s bandwidth boom. Yet corporate boards, productivity data, and capital expenditure plans still point to AI adding around 0.5 percentage point to U.S. productivity growth over the next several years, which, if realized, would offer genuine fundamental support under parts of the theme. Under the surface, leadership is rotating away from a narrow group of mega-cap AI names and toward a much broader set of cyclicals and rate-sensitive stocks. Materials, financials, and healthcare are printing record highs. Small caps are nearing all-time highs, and the Russell benchmarks are close to outperforming the large cap index on a full-year basis for the first time since 2020. A dovish tone from the Fed has fueled pronounced gains in banks, transports, and smaller domestically focused companies, although recent strength in high beta cyclicals already looks stretched if the macro data fail to keep improving. There's also a geographical rotation underway. Fund managers are nudging equity exposure away from the United States toward international markets, citing better valuations and stronger expected growth into 2026, while emerging markets have outperformed this year with wide dispersion that rewards selectivity. Retail investors are playing an important role, deploying capital at nearly twice the 5-year average and increasingly using exchange-traded funds, even as some flows migrate toward perceived safe havens like gold and silver. All of this is taking place against a K-shaped economic backdrop, where wealthier households benefit from rising asset prices while lower income confidence sits near lows, raising political and policy risks for markets. Index-level valuations, especially in U.S. large caps, imply that long-run returns may be only in the low single digits. So a lot now rests on the soft landing narrative, the durability of AI-driven earnings growth, and the Fed's ability to maintain credibility while easing. As we turn to rates, those tensions between policy support, high real yields, and market skepticism become even more apparent. In rates, the defining feature is a Federal Reserve that is easing with the handbrake on. The central bank has just delivered a third consecutive quarter-point cut, bringing cumulative reductions to around 175 basis points. Its projections still show above-trend growth next year and only one additional cut penciled in. The committee itself is unusually split, with a meaningful group arguing for 2 or more cuts, which erodes the signaling power of the dot plot and leaves markets leaning more heavily on incoming data. Alongside rate cuts, the Fed will start buying up to $40 billion of Treasury bills, a balance sheet move that exceeded expectations and is being interpreted as quasi-quantitative easing. Those purchases, together with ongoing support for the repo market, have anchored the very front end and sparked rallies in short-dated treasuries, highlighting how sensitive markets are to liquidity tools as much as to the policy rate itself. They also reduce the near-term risk of a funding squeeze early next year. Further out the curve, the message is very different. 10-year yields have risen from around 3.65% to over 4.1% despite the easing cycle, and real yields remain elevated, suggesting investors are unconvinced that cuts will be aggressive or long-lasting. Services inflation is still running in the mid-3% range. Goods disinflation has largely played out, and tariff-related price pressure is expected to keep consumer prices firm into the first quarter, all of which helps explain why term premia are staying high. Globally, policy divergence sharpens the rates picture. The Bank of England is seen easing more slowly, especially after higher inflation projections and a budget that failed to shift gilt market pricing, while the Swiss National Bank has kept rates at zero amid lingering deflation concerns. Upcoming meetings at the European Central Bank, the Bank of England, and the Bank of Japan will be watched closely for confirmation of this mixed backdrop, even as political debate about Fed independence simmers in the United States. For allocators, the key watch points now are how quickly labor market softness develops, whether services inflation finally rolls over, and whether long-end yields stabilize or continue to test markets' tolerance for higher real rates. Credit markets still look calm on the surface, but the underlying risk-reward has become much more asymmetric. Investor positioning in U.S. credit is near 15-year highs, and spreads sit close to historic tights, meaning investors receive limited extra compensation for taking credit risk at this stage of the cycle. High-yield bond market size has been flat for several years as weaker borrowers migrate into the floating-rate loan space, leaving the remaining bond universe of somewhat higher average quality, yet overall system leverage remains elevated. Beneath listed markets, private credit stands out as a potential pressure point. Funds have taken on tight spread, high leverage deals with a growing share of exposure to technology, and tech now accounts for more than 40% of private credit portfolios in some estimates. Many of these loans finance highly leveraged, unrated tech or AI infrastructure plays where default risk is harder to assess and disclosure is limited, creating the potential for hidden stress if growth assumptions are not met. Oracle has become an emblematic example of how AI and credit risk can intersect. Its 5-year credit default swaps have climbed to their highest level since 2009, reflecting negative free cash flow, a debt load that has roughly doubled to around $100 billion, and heavy investment in AI infrastructure that has yet to translate into matching revenue. Some market participants now treat Oracle's credit spreads as a proxy for broader AI-related credit risk, drawing parallels to early signals from past credit cycles. At the same time, investment-grade issuance is surging as companies finance a capex supercycle, particularly across technology and AI infrastructure, which keeps primary markets busy but also adds to future refinancing needs. Regulators are stepping up scrutiny of private credit structures, bank lending to these vehicles, and synthetic risk transfers, which could reshape how risk is distributed across the system. There is a widespread expectation that if credit conditions were to tighten sharply, central banks would respond with even more dovish policy, which could in turn favor real assets like equities and commodities while raising questions about the long-term purchasing power of fiat currencies. For now, though, very tight spreads and concentrated exposures leave credit looking vulnerable to any growth or policy shock. In foreign exchange, the notable development is that the U.S. dollar has softened even as the backdrop for U.S. risk assets remains supportive. Recent moves have been driven less by growth data and more by front-end rate dynamics and the Fed's liquidity operations, which together have reduced the relative carry on the dollar. Looking ahead, diverging central bank paths, with the United States expected to ease while some other regions lean more hawkish, are likely to keep a gentle headwind on the dollar and could continue to underpin relative outperformance in select international and emerging markets. FX markets also sit at the intersection of equity and rates risks. One scenario being discussed is that a sharp correction in AI-driven equities, if it forced the Fed into faster cutting, could see traditional core currencies such as the euro, Swiss franc, and yen outperform as investors seek perceived safety. In that environment, higher beta commodity currencies like the Australian, New Zealand, and Canadian dollars might struggle, especially if global growth expectations were revised lower alongside the equity sell-off. Alongside traditional currencies, crypto assets are moving further into the institutional toolkit. Regulatory shifts, including in the United Kingdom, and rising inflows from Europe, Asia, and the Middle East are supporting broader adoption, with crypto increasingly functioning both as a high beta proxy for risk sentiment and, for some allocators, a small diversifier within multi-asset portfolios. Against this backdrop, currency markets remain a key channel through which differences in policy, growth, and risk appetite are being expressed. Commodities are quietly regaining importance in the cross-asset picture. Gold and silver have surged, with gold trading above 4,300 and silver above 64, helping to drive double-digit gains in many precious metals miners, especially those seen as improving margins or integrating new acquisitions. The broader commodity index has moved back above its 200-day moving average, which some see as an early signal that real assets are entering a more constructive phase after a long consolidation. In energy, sentiment on crude oil is cautious, with forecasts of a potential supply glut by 2026 weighing on prices. However, geopolitics complicate that picture, as evidenced by the U.S. seizure of a Venezuelan tanker, ongoing debates over sanctions, and the possibility that political change in Venezuela could eventually unlock significant new supply. Elsewhere, reports of Ukrainian drone strikes on Russian fertilizer plants have jolted fertilizer stocks and reminded markets how quickly supply chain disruptions can transmit through to commodity producers and end-user inflation. Beyond traditional commodities, the energy transition is becoming a more prominent driver. Renewable energy in Europe is highlighted as underappreciated, especially as AI and data center growth intensify demand for reliable, efficient power, and individual names in the oil and gas space, such as ExxonMobil, are showing technical strength even as spot crude prices drift lower. If credit stress were to emerge, many expect central banks to respond with easier policy, a backdrop that historically has tended to favor a diversified basket of real assets, including commodities and related equities, as a hedge against currency debasement and policy uncertainty. That brings us back to the overarching cross-asset balance between liquidity support and late-cycle risk. Pulling the pieces together, we have a market where central banks, led by the Fed, are easing policy and injecting liquidity, even as long-term yields, AI valuation debates, and tight credit spreads signal a late-cycle environment with thinner safety margins. Equities enjoy strong breadth, powerful AI and capex stories, and robust retail and global flows, but also face demanding valuations and growing differentiation between winners and laggards, both in technology and beyond. Rates markets express skepticism through elevated real yields and steep curves, while credit is heavily owned and increasingly exposed to opaque private structures and AI-linked balance sheet risks. Meanwhile, a softer dollar, rising institutional interest in crypto, and a firmer tone in gold, silver, and broader commodities show that investors are quietly diversifying their stores of value as they navigate policy uncertainty and geopolitical frictions. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.